All right, so we're going to spend a little bit of time now on a case study, and it's talking about the optimal retirement structure. Now, you'll notice in these three scenarios, each client has total assets worth $7.5 million. Now, even if you don't think your assets will get to that level, that's fine. Many of these concepts still remain the same, even if your assets at retirement are 2 million or 3 million or what have you. What we're really looking at is the differences from a cost, income, and tax perspective, both now and in the future, across these three different scenarios. So scenario one, this is what we'd consider a pretty optimal retirement structure. The clients have a $2 million family home. They've got $3.8 million in their pension account, so $1.9 million each, which is the maximum that they can have in that fully tax-free environment. Then they've got $1.2 million in Australian shares. And the reason why they've got $1.2 million is based on the dividends that these produce. Let's assume at a 5% yield, that would be $60,000 of income. And that's split in half, so $30,000 each if they own the shares jointly. Then that amount of income is actually below the tax-free threshold for seniors, because seniors get this extra uplift called the seniors and pensioners tax offset. So they're actually not paying any personal income tax with that amount of Aussie shares. And as well as that, Australian shares provide something called franked dividend refunds when you're below the tax-free threshold, which actually gives you a refund of the tax that the company has already paid on your behalf. So let's say they're all in, Telstra and BHP shares and things like that. Telstra and BHP already pay company tax for you on your behalf, and then you can actually claim that refund as well. So it's really good. Now, with the last $500,000, that's in superannuation, because we don't want to have any more money in the shares because it could start triggering income tax, and they also can't have any more in their pension account. So really, it's just to show what you do with the overflow, and that would be in superannuation taxed at 15%. Firstly, their income now, they've got $5.5 million of their total $7.5 million in investable and income producing assets. And generally you want a high proportion in those investable and income producing assets rather than in your property, because that's what you're going to live on long term. And that could generate $225,000 per year at 5% income yield. Next, we want to look at the tax. This is where this strategy really shines. It's an extremely low tax approach. Only the $500,000 in super is likely to pay any tax, and that's at a 15% tax rate, as we know. So again, assuming that makes a 5% yield, then it's only $3,000 per year. The costs are also very low in this situation. So when we compare that in a few slides to property, property has a lot more ongoing costs, whereas for shares, there's actually basically no ongoing costs. Super and pension fees are really low, particularly as your balances get higher. And then you've just got the normal maintenance with your primary residence costs. Now, in the future, and we'll talk primarily about inheritance in this situation, it's likely that the primary residence would be sold. Superannuation and pension assets would be converted to cash for whoever the beneficiary is. The share income could remain if the beneficiaries want to keep those shares. From a tax perspective in the future, it's also quite a good outcome. Now, when your beneficiaries sell the primary residence, it's unlikely to have any tax when sold in the first 2 years. So it still gets that primary residence capital gains tax exemption. With superannuation and pension accounts, they have both what's called a taxable and tax-free component. And there are a range of strategies from age 60 to 75 where we can actually increase the tax-free component of the superannuation balance and get a good outcome there for beneficiaries. With the taxable component, so it's typically tax-free when given to your spouse, but adult children often pay a 17% tax on the taxable component of the super balance. Now, the capital gains tax on shares can be easily managed when passed on to beneficiaries because shares are quite liquid. And what that means is they can be sold in really small portions. So you could even decide to retain the shares fully, or just gradually your beneficiaries could sell the shares in small parcels so to not trigger too much capital gains tax in one hit, which, as you'll see in a few slides, you can't do that with property. You either have to sell it or retain it. And as we know, the costs with this structure are very low.